All right, so I think this will be our last slide for property, or sorry, last video for property, plant, and equipment. So we're going to kind of jump right into it. So subsequent events. So essentially, obviously, whenever you initially purchase an asset, you have all of those initial costs. However, there may be some additional costs to operate that business long term. And so the question is, how do we treat those additional costs? Do we expense them or do we capitalize them? And so really when we talk about subsequent events, that's what we're talking about here is should I capitalize or should I expense those subsequent costs after I first acquire the asset? And so, as a general rule, if the cost will have a benefit beyond the current fiscal year, then it should be capitalized. Now, we're going to get into a little bit of nuance on that, but basically, if there's a long-term effect, then you should capitalize it. If it's a short-term effect, then we would just expense it. So expenses are some examples of things that might increase future benefits beyond 1 year. It could be something that extends the service life. So, I overhaul an engine on a semi truck, and all of a sudden I can drive it for another, 500,000 miles. That's a significant thing. It's extending the service life or the useful life. Another one might be something that increases the operational efficiency of the asset. So that allows you to either increase the quantity of goods or services or decrease future operating costs. So I think the example I might use in this is like that you get a new compressor or something, and all of a sudden, boy, I can churn out more items, or now my costs to turn out each item is much less. And so that would be another expenditure that has benefits beyond a year. And then finally, there could be some addition where all of a sudden the quality. So maybe you spend money on a machine to make it more precise in the way that it cuts, right? So that your part, instead of having an error rate of 1 out of 1,000, has an error rate of 1 out of 10,000, right? So the quality of your goods is going to increase, and so that would be another example where there'd be this future benefit. And sort of broadly, just sort of thinking about things, a question that always comes up is repairs, and I would call it like regular maintenance. So repairs and regular maintenance usually are just going to be expense because the idea is that it really doesn't increase the future benefits, it's just allowing you to actually reap those benefits. So like as an example, if you think about a vehicle, right? If I buy a fleet of trucks and I change the oil, or I, do a tune-up or change the spark plugs or change the tires or whatever it might be, it hasn't fundamentally changed how I can use that vehicle. It's just sort of a necessary cost to keep that vehicle running. So, repairs and regular maintenance, they're just going to be expensed as they are incurred. Additions are a little bit different. So an addition would be basically a change to that. So let's say I have this group of vehicles and I add some refrigeration where all of a sudden now I can carry perishable goods, whereas before I couldn't. Well, that would be something that would be capitalized. Or let's say that I have a building and I add like a storage unit on the end or a new wing. Well, that's an addition. That's something subsequently that does absolutely changes the future benefits of that asset. And so again, just kind of making that distinction is important. That cost of the addition, again, it's going to be added to the asset. It's going to be recorded as an asset and depreciated over the remaining life of the original asset or its own. And so with some of those things, they basically sit sort of side by side. So in addition, sit side by side. But where it's a little bit different is improvement. So addition is sort of, I've got it and I've added something sort of fundamentally different. And improvement is a little bit different in that it's a replacement of a major component of an existing asset. So if you think about the previous example, we're not really replacing anything, we're adding something to it. With an improvement, the key is that it's replacing something. So the cost of the improvement is added to the value of the original asset rather than being tracked as a separate asset. And so then there's a new total that's going to be depreciated over the remaining service life of the improved asset. Now, obviously, the replacement might lengthen the service life. So, there's a lot of things that might go into this. But again, we're taking that improvement, we're just rolling it into the cost or the capitalized cost of that asset. There are three methods that are acceptable under US GAAP for handling, capitalizing those improvements. One is called substitution. A substitution basically means you take the old asset off your books and just bring the new asset on your books, whatever, but just the cost of that improvement. Um, Essentially what happens here is you're separating the component from the underlying asset. So you're kind of almost acting like the underlying asset got sold and that you're replacing it with just the improvement. So while it's acceptable, it's not often used, and you're probably going to see why here in a second. The second one, and this is the most common one, is you just add the cost to the asset. So whatever the cost of the improvement is, you just add it. And so the key here though is the original component just needs to be sort of immaterial. In other words, if the original component kind of is the most important thing, then maybe you can't use this. But most of the time you're going to be able to use this because any individual component is, like replacing an engine in a car, right? So that's not, while it's not the value of the car isn't just the engine, it's all the other things that go into it. And so that materiality can kind of be a little bit squishy, but that the overall the engine I think would probably fall into this. But you could argue maybe that it is material and should be tracked separately. And then finally, or should be a substitution. And then finally, reduction, the accumulated depreciation. So I'd say two and three are very similar in that you're sort of just rolling it into the existing accounting. One is you're increasing the capitalized cost, and the other one you're decreasing the accumulated depreciation, and both essentially collectively arrive at the same place, just slightly differently. All right, so let's go through an example. Several pieces of equipment in its manufacturing process. The original equipment had a $600,000 cost, 6-year useful life, and a $0 residual value. And the original equipment was purchased 4 years ago. The company ordered new compressors for all the equipment with a cost of $100,000. The new compressors will extend the service life of the equipment by an extra 3 years. The company also received $8,000 for the old compressors, and just assume everything is a cash transaction. So let's record this using all three methods and assuming straight line depreciation. All right, so in the first one called substitution, first of all, we remove the book value of the old equipment. So there would have been $100,000 of depreciation each year for 4 years. And so there would have been $400,000 in accumulated depreciation for a book value of $200,000. And so we take off the accumulated depreciation and we take off the equipment. Of course, we received $8,000 cash for the old compressors, and that difference would be a $192,000 loss. Now, with the substitution, there's really two journal entries. One is you remove the old equipment, and then the second journal entry is you add on the value of that improvement. And so it would just now be the equipment would have a cost of $100,000, and then you depreciate that going forward for those remaining number of years. And so, so again, I think the big hang up here is taking the loss. Most companies probably don't want to record that, but it is an option. Again, the most common one, capitalizing the new cost, is essentially you take the net cash. So again, I paid 100,000, but I received 8. So I made a net cash payment of 92,000, and I just add that to the cost of the equipment. So now the equipment cost is just $92,000 more. And so instead of being 600, it would now be 692. And again, 2 and 3 are similar. Instead of having an increase to the equipment cost, we could just decrease the accumulated depreciation. This one isn't used very often, but it is acceptable, so we just wanted to show it. But same net cash. Again, instead of increasing the basis, instead of increasing the capitalized cost, we're decreasing the accumulated depreciation. And so what's the new depreciation under the three approaches? If we did the substitution, it would be $20,000 a year. If we did the capitalized cost, again, we'd be increasing that capitalized cost from 600 to 692. Of course, we already had depreciated 400,000, so the depreciable base now is 292 divided by the remaining 5 years is 58,400. And then the third one is similar, but instead of increasing the capitalized cost, we decrease the accumulated depreciation. Again, that depreciable base is still 292 divided by 5, and we get 58,400. Again, not too complicated, I don't think. Rearrangements is the final topic here. Basically there might be a new capability for the asset. Again, maybe you're changing the way you use something, but you had to pay costs in order to figure out how to do that or to implement that. But again, the key here is if it's material and has a future benefit, then you would capitalize it and you'd expense it over time. If you can't clearly or materially identify that, then you just would expense whatever it was at the time. Again, don't want to get too hung up on that topic, but it is a final subsequent events topic. But that's all I've got. Hopefully these are helpful and we'll kind of get these posted as soon as possible.